Hi there, welcome to the second of our 3 explainer videos on founder dilution. In this video, we'll look at a few examples of how founder dilution works in practice, using typical venture finance structures. This will get a bit into cap table math, which is surprisingly tricky. So don't feel bad if it feels a bit confusing at first. It's just that way for pretty much everyone. So let's jump right in with our first example. So let's say that we have a company called Cold Potato. Now, Cold Potato's in the agritech storage business, and it has 2 founders. And these 2 founders own together 3 million shares, or 100% of Cold Potato. Now, let's suppose the founders decide to hire some employees and realize they need to offer stock options to attract top talent. So they get that set up, and they set aside 333,000 shares for issuance under the stock option plan. Now, those 333,000 shares aren't issued right away. The company first grants options, then those options have to vest, and then the employees have to exercise. But if they were, that option pool would dilute the founders' interests. And it's important to track this. That's what's called fully diluted capitalization, or what the capitalization of your company would look like if all the options and other convertible instruments converted into shares. So for Cold Potato, the fully diluted capitalization at this point is going to be 90% for the founders and 10% for the option pool. Now let's say that the founders want to raise some money. They decide to raise $200,000 through a simple agreement for future equity, or a SAFE. A SAFE is just a type of convertible instrument, and a convertible instrument is a type of security that converts into shares at some point. There are a few different flavors of SAFE, but let's say that this one is the simplest one and converts into shares at a 20% discount to the price per share when the company decides to raise money by selling shares, which is commonly referred to as a priced round. With the SAFE in place, things get a bit more complicated for our capitalization. The founders still own 90% of the fully diluted shares, but there is now some other interest out there that could, in theory, convert into shares of the company. But we don't know what that is right now. All of that depends on the future value of the company. So the founders are really taking a risk here that their assumptions about Cold Potato's future valuation will pan out. So let's look at a model of what that could look like. Let's say in 3 months, the founders are able to do a seed financing, and a venture capital fund agrees to invest $1 million for a 20% stake in Cold Potato. So based on the 2 numbers that we know about the VC fund's investment, we can calculate what's called the post-money valuation, or how much Cold Potato will be worth after the VC fund invests. In this case, the post-money valuation will be calculated by taking the $1 million invested by the VC fund and dividing that by the 20% that the VC fund will own after the investment has closed, and we end up with $5 million. So after this investment round, Cold Potato will be worth $5 million. With the post-money valuation, we can now calculate the actual percentage that will be owned by the SAFE holders without even knowing the price per share. We do this by dividing the $200,000 that was initially invested by the SAFE holders by 100% minus the discount, which is 20%, and then we divide all of that by the post-money valuation of $5 million. This gives us 5%. So at this point, we know the SAFE investors will own 5% of Cold Potato on a fully diluted basis, and the investors will own 20% of Cold Potato on a fully diluted basis. But we still don't know the percentage of the founders or the percentage of the option pool. To do that, we'll calculate the fully diluted shares after the financing. To do this, we just take the 3 million shares that the founders own, and we add the 333,000 shares reserved for the option pool. Then we divide that by 100% minus the 5% that the SAFE holders will own minus the 20% that the investors will own. And we end up with 4.44 million shares. So that's how many shares will be issued out and outstanding after this seed financing. With the total fully diluted shares, we can easily calculate the price per share by dividing the post-money valuation of $5 million by the 4.4 million shares for a price per share of approximately $1.14. However, the more important thing for our diagram here is the fully diluted ownership percentages. The founders still hold 3 million shares, but those shares now only represent 67.5% of the total fully diluted shares. Likewise with the options, their stake will have fallen to 7.5% of the fully diluted shares. Okay, so that's one scenario. But with convertible securities, the realities can change really quickly. So let's have a look at another example backing up to before the seed round. Let's say that the company didn't have as many financing options and had to take a worse deal. Say instead of a $1 million investment for 20%, the VC fund would only put up $600,000 for a 20% stake. Calculating the post-money valuation then, we divide the $600,000 that was invested by 20%, which gives us $3 million. From here, we can calculate the safe ownership percentage, like we did last time, which is just $200,000 divided by 100% minus the discount, and dividing all of that by the $3 million post-money valuation, which gives us 8.33%. If you recall from our last example, the safe holders only had 5% on conversion, so that extra 3.33% is going to dilute the founders and the option pool. So to assess that additional dilution, let's get the total fully diluted shares, which is just 3 million plus the 333,000 reserved for the option pool, divided by 100% minus 8.33% for the safes minus 20% for the investors, which gives us 4.65 million. And from here, we can calculate the fully diluted ownership percentages, which are 64.5% for the founders, 7.17% for the option pool. And we, of course, know that the safe investors will have 8.33% and the investors will own 20%. Now, 3% may not seem like a big deal, but even 1% could be a seven-figure difference on exit. But this could have been a lot worse. What if the company had only been able to raise $500,000 for 30% of the company? In that case, if you run the math, the founder ownership percentage would plummet to only 49.5%. All of this really just emphasizes the importance of testing your assumptions before using a convertible instrument like a safe to raise money. Convertible instruments are convenient because they defer the need to value your company, which is difficult to get right when you're just starting out. However, that convenience can come at a very high price if your assumptions about the future don't pan out. So before you jump into a convertible financing, I'd strongly recommend talking to a lawyer or an advisor, and don't just trust whatever your investors are telling you. It's really important. So that's it for video 2 of our 3-parter on founder dilution. In the last video, we'll keep this example going with a Series A financing to look at the impact of option pool top-ups and then leave you with some final thoughts and takeaways. Thanks for watching.